Is the economy headed for a recession? Oil price spikes are a solid indicator of a market recession, and although not every recession in history has been caused by a surge in the oil prices, erratic movement in the prices of commodities can create an economic recession due to the global intermingling of the production, distribution, refinery locations and storage contracts for many commodities. And due to the impact of the COVID-19 pandemic, the strength of the economy was already fragile due to quantitative easing, stimulus payments, rising inflation and supply chain delays. Thursday, 10th of March, will be a huge day for the global economic community as the European Central Bank releases its monetary policy statement and main refinancing rate at its press conference. There are concerning reverberations through the whole European continent regarding the high level of inflation expected due to the impacts of the Russia-Ukraine crisis on the already high energy prices the UK especially has been experiencing. The US monthly CPI and core CPI data will also be released, although the high inflation levels of 6 to 7% expected in the UK are more than likely not to be expected in the US, as the Federal Reserve's Jerome Powell has indicated that a rate hike of approximately 25 basis points is to be expected sometime in 2022. Due to more positive economic data. And that said, Monday's close on Wall Street did see the biggest drop since October 2020, with the S&P 500 sinking 3%. The Dow Jones Industrial Average entered correction zone, dropping 800 points as the bear continues to swipe down. Even the Nasdaq was not rescued from its heavy-handed push downwards. Australia's Reserve Bank of Australia Governor Philip Lowe will also speak at 5:15 p.m. Australian Eastern Daylight Savings Time, Thursday, 10th of March, and from his last address he offered a dovish outlook on the need to raise rates due to the lower than usual levels the rising inflation and labour costs are stemming from. Monday's flat opening of the ASX still counted towards 3 straight days of declines as the index inched up 1% during the mid-session. The impact felt by the copper-nickel energy companies after the London Metal Exchange halted trading of nickel as the price hit the roof, reaching over $100,000 per tonne. And despite Tesla's share increasing at Friday's close on Wall Street, the stock is a big part of Cathie Wood's ARK investment portfolio, which dropped significantly by 40%, as did Tesla's stock, plunging 33%. The sanctions surrounding the Iran-US nuclear deal is again in the spotlight as things have escalated quickly in the Russian crisis, with Tesla's billionaire CEO Elon Musk urging for more oil and gas outputs. The US and Europe have both placed sanctions on Russia's gas sector today, and Europe is heavily dependent on Russian gas. Iran, the oil-rich Middle Eastern country, advised they were keen to discuss the lifting of US sanctions and revive the 2015 nuclear deal. Last week, they had the ability to export 2.5 million barrels per day out of a total production of 4 million barrels per day once the US sanctions were lifted, they said, and reported by the Times of Israel. As the conflict continues in Russia, sending the global markets into a tailspin, the oil majors, being led by their ethical investor sentiments and strong ESG policies, have concluded from the CERA meeting held in Houston, Texas, that renewable resources will be a slow fix to a big problem that can't be fixed in a hasty manner. It was reported by Seeking Alpha. The Kremlin continues on its narcissistic preamble, putting the impetus of action on Ukraine, stating it is because Kiev is not meeting its conditional requests that the Kremlin are unable to halt military operations in the country. In the words offered from the Kremlin, they would stop military infiltration in a moment if Kiev met their agreed specific conditions, including changing its constitution to enshrine neutrality, eliminating possibility of NATO and EU membership, ceasing military action altogether, recognising separatist republics of Donetsk and Luhansk, as well as total claiming of Crimea as Russian territory. It's almost certain that a rejection of these conditions by Kiev could lead to further downturns in the economic markets. An analyst from Strategas Securities, Ryan Grabinski, spoke to Seeking Alpha, saying perhaps the scary part is that in 1990, during the Gulf War, the Fed funds rate was at about 8% and eventually embarked on an easing cycle. But today, the Fed is at the beginning of a hiking cycle, and it seems more and more likely that a recession is unavoidable. It seems whichever way the Federal Reserve goes, that the same outcome is due, which puts it in between a rock and a hard place. If you do like this information, please let us know by liking, sharing, commenting on the video below, and subscribe to the channel. Press the bell icon to be notified of the latest videos from Kalkine, and please head to the website for more articles like this. I'm Sage for Kalkine Media.